get to 1 million. It's so far. I'm so tired. Can't stop.
Open your 401k statement right now. Look at the number at the top. That's the lie. I don't mean your account is fake. The money is real. The number is accurate. But what it can actually buy you in retirement is not what you think. If your statement says $1 million, your real spendable wealth, for most Americans, is closer to $620,000, sometimes less. Almost $400,000 gone, not stolen, quietly evaporated by costs the IRS reveals only after you start withdrawing. Today, we audit your retirement number. Pull back the curtain, look at what you actually own. I'm Jeff. This isn't a video about saving more. It's about understanding what your savings already mean. 3 Americans today. Each has exactly $1 million on their statement. 3 identical numbers. 3 very different lives. Greg, 62, 2 years from retirement. $1 million traditional. About to discover the audit, nobody runs for him. Susan, 66, retired 2 years ago. Same $1 million starting balance. Did one specific thing in her early 60s that's quietly working in her favor. Frank, 66, retired 2 years ago. Same $1 million. Did nothing different. Already paying for it. 3 people. 3 identical balances. Wildly different spendable wealth. By the end, you'll know which one you're heading toward. Quick note, not financial advice, not tax advice. A framework. For your situation, talk to a CPA and a fiduciary. Stay with me. 14 minutes. By the end, your retirement statement will look different to you. Let's start with the question almost nobody asks. When you look at your 401k balance, whose money is it? Yours or the future tax bills? Hidden cost number 1, future income taxes. Every dollar in a traditional 401k is pre-tax, meaning you have not yet paid income tax on a single penny of it. The IRS is patient. They let you defer, let it compound, but they keep the bill open. When you withdraw, every dollar gets taxed as ordinary income. Federal rate, plus state, sometimes city. Let's audit Greg, his $1 million. He plans to spend roughly $80,000 a year in retirement. To get $80,000 spendable, Greg has to withdraw considerably more because of taxes. Federal at his bracket, about 22%. State, average 5%. Combined, roughly 25%. To net $80,000, Greg actually needs to withdraw about $107,000. The IRS quietly takes $27,000. Over a 25-year retirement, $675,000 in pure federal and state taxes from a $1 million account. Suddenly, Greg's $1 million looks more like $325,000 of true retirement spending over his expected lifespan. But we've only counted hidden cost number 1. There are 2 more. Hidden cost number 2, Medicare 𝐕RMA surcharges. Most Americans assume Medicare costs the same for everyone. It doesn't. Medicare punishes you for too much retirement income. It's called 𝐕RMA, Income-Related Monthly Adjustment Amount, a surcharge on Part B and Part D when income crosses thresholds. In 2026, trigger is $109,000 single, $218,000 married. Cross that line. Medicare costs more every month for life. Here's what people miss. Your 401k withdrawals count, Social Security counts, capital gains count, even tax-exempt muni bond interest counts. Greg plans $80,000 from 401k, plus $30,000 Social Security. Combined, $110,000 individual. Just over the threshold. Greg's Medicare Part B alone jumps from $203 to $284. Plus Part D surcharge. Doubled if married. Doesn't sound like much until you compound it. Greg pays roughly $1,000 a year extra. Over 25 years, $25,000 vanishes. And if Greg's income rises through inflation, larger withdrawals, RMDs, his 𝐕RMA bracket rises with it. Up to $487 a month extra on Part B alone. Per person. For couples, surcharge is per person. Both spouses on Medicare hit 𝐕RMA. Surcharges double. Now we've lost income tax. We've lost 𝐕RMA. But there's a third cost, and it's the most dangerous because the IRS forces it on you. Hidden cost number 3, the required minimum distribution, RMD. Starting at age 73, for most watching this, The IRS forces you to withdraw a percentage every year, whether you need the money or not. Miss the deadline? IRS penalty is 25% of the shortfall, reduced to 10% if corrected quickly. They are not joking. The math. Year 1 of RMD, age 73. The IRS divides your account by 26.5. Roughly 3.8% of your balance forced out. Divisor shrinks every year. Age 80, 5%. Age 85, over 6%. Age 90, over 8%. Money keeps growing. Forced withdrawals grow faster. Why does this matter? If Greg doesn't need that money, he still pays tax on it. Every RMD dollar gets taxed as ordinary income. And the dollars he didn't want to withdraw push his other income into higher brackets. Trigger 𝐓𝐈𝐌𝐄𝐒. Tax up to 85% of his Social Security. It's a cascade. Each effect triggers the next. It starts at 73. You can't easily stop it. Now, let's look at how two people with identical $1 million balances ended up in completely different realities. Same age, same income, same career, same returns. Both retired at 64 with exactly $1 million in 401k. One decision separated them. Frank did what most Americans do, retired, let his 401k sit, withdrew what he needed, waited for RMDs at 73. Susan did something different. From age 64 to 72, the 8-year window between retirement and her first RMD, she did Roth conversions every year. A Roth conversion. Move money from traditional to Roth. Pay tax now. Once it's Roth, grows tax-free. Withdraws tax-free, no RMDs, ever. Susan converted about $60,000 a year for 8 years. Total, $480,000. By 72, almost half her account was Roth. Why those years? Susan was retired, no salary, Social Security deferred. Her tax bracket was unusually low, 22% federal. She paid 22% on each $60,000 conversion. Total tax over 8 years? About $105,000. Sounds like a lot. Susan voluntarily paid the IRS $105,000 she didn't have to pay yet. Why? Because of what happened next. At age 73, her remaining traditional balance was much smaller. RMD was much smaller. Taxable income stayed lower. Lower RMD meant lower income. Lower income meant Susan dodged 𝐓𝐈𝐿. Only 50% of her Social Security got taxed instead of 85%. And the Roth portion, $480,000 plus growth, never triggers RMD. Never triggers 𝐓𝐕. Withdraws tax-free. Let's run the comparison out 25 years. Both started $1 million. Same growth rate. Same spending. $80,000 per year after tax. Frank's lifetime taxes, federal, state, 𝐓𝐕 combined, about $810,000. Susan's lifetime taxes, including the $105,000 she paid voluntarily, about $510,000. $300,000 difference. Same starting balance, same retirement goal. One decision saved Susan $300,000 over her lifetime. Here's the part that should sit with you. Frank didn't make a mistake. He followed the most common path. The default path. Susan didn't do anything brilliant. She just did one specific thing in one specific window. The window most people drift through without realizing it. Now back to Greg. 62. 2 years from retirement. $1 million traditional. No Roth conversions yet. Greg is exactly where Susan and Frank were before they chose. The window is opening for him. He gets to decide. Math says, if Greg takes the Susan path, the same $1 million provides a different retirement. Not because the number grew, because more stayed his. If you're watching in your 50s or 60s, Greg's question is your question. 3 concrete actions you can take this week. Action 1. Calculate your real number. Current 401k balance times 0.75. That's your rough real value after federal taxes. Statement says $800,000. Real spendable is closer to $600,000. Live by that number, not the statement. Action 2. Identify your conversion window. 55 or older? Start thinking about the gap between retirement and 73. That's your tax control opportunity. For most Americans, 6 to 10 years long. Treat it like a project, not a passive phase. Action 3. Open a conversation with a fee-only fiduciary financial planner. Not commission-based, not your bank. Fee only. Why fee only specifically? Commission-based advisors get paid more when you keep money in traditional 401k. Incentives don't match yours. Fee-only fiduciaries are required by law to act in your best interest, even when it costs them business. That's the voice you need. $1 million statement. Paying $2,000 to $4,000 for a one-time audit may save you 10 or 20 or 30 times that. Now, the reversal. I spent 14 minutes showing why $1 million isn't $1 million. You might think, my retirement plan is broken. It's not. The lesson is the opposite. Your plan is salvageable, but only if you actually look at it. Damage happens to people who never audit. Frank's situation isn't a tragedy, it's a default. The outcome for almost every American who did the saving, but never looked at what came next. Susan isn't a genius. She's just a person who did one specific audit at one specific moment. The audit costs nothing if you do it yourself. A few thousand if you hire help. Saves multiples of that, usually hundreds of thousands. Here's the principle to take home. Your retirement statement is a forecast, not a balance. The number is what your account holds, before the IRS, Medicare, and time have their say. What you actually own is what's left after all those costs are subtracted. That's the only number worth planning around. Susan knows her real number, Frank doesn't. Greg is about to learn his. So, where are you? Susan, Frank, or Greg? About to choose? If you have time, in your 50s or early 60s, you have everything you need to be Susan, not Frank. Already retired? Not too late. Window is smaller, but the audit matters. Even 3 or 4 years of strategic conversion shifts your trajectory. In your 70s and already taking RMDs, the conversion ship has mostly sailed. But qualified charitable distributions and asset placements still help. Different video. Disclaimer one more time. Not financial advice, not tax advice. Examples illustrative. Tax laws change. Talk to a CPA and a fiduciary. Comments. Tell me what your statement says. Have you done the multiplication? Calculated your real number? Has any advisor ever explained 𝐓𝐈𝐌𝐄𝐒 to you before this video? Or did you discover it on your own? If this changed how you see your statement, share with one specific person, someone in their late 50s, someone with a large traditional 401k, someone who's never heard the word 𝐓𝐹MA. They'll thank you, quietly, years from now, when they realize what they almost missed. Next video. The Roth Conversion Ladder. Specific numbers, year by year. How to design your window for maximum tax efficiency. Subscribe. Until then, remember the principle. Your statement is not your wealth. Your statement is a forecast. What you keep after taxes, after 𝐓𝐹MA, after RMD cascades, that's your wealth. Run the audit now, before you need to. Take care.